I'd like to take a moment to introduce our next panel for the day, which I will be moderating. My name is John Krowas. I'm Vice President for Quantitative Products at Capital IQ. Our panel today is going to be taking a look at risk in a lot of broad forms. We have some great guest speakers up here and some interesting views on best practices. Before we get into the discussion itself, I'd like to ask each of them to just briefly introduce themselves and give a little bit about their background. Tim?
Tim Wilson. I'm Chief Risk Officer for the hedge fund Caxton Associates. We've been around, although I have not been with Caxton for this period of time, for 20-odd years. I've been at Caxton since about '03, and before that I was at Morgan Stanley in risk, before that at the Federal Reserve Board in Washington.
My name is Mike Stohler. I am the Chief Risk Officer of JP Morgan's hedge fund platform. I'm actually coming from the private bank, which is JP Morgan's largest pool of external hedge fund assets, which is around $22 billion. It's been a pretty exciting place to be in the last few years. In the past year, I think we were, if you believe the HFR numbers, we were somewhere in the neighborhood of 10% of global hedge fund flows. Before JP Morgan, I used to do physics for a living, but I would say that most of what I do now is a lot more qualitative than quantitative in terms of risk assessment.
And I'm Michelle Clayman. I'm the founder and managing partner and CIO of New Amsterdam Partners here in the city, and it's a firm that I founded 25 years ago. And I come here wearing a number of hats. Obviously, I'm an asset manager. I also sit on a number of finance committees and boards of not-for-profits, so I see things from the other side as well.
I'm Brian Golob. I work for Russell Investments, where I'm the Global Chief Compliance Officer there. One of my responsibilities at Russell Investments is core business is a manager of managers investment management business. So we hire something like 230 currently investment managers from around the world. And part of my responsibility includes doing due diligence and oversight of those managers. So we look at the operational and regulatory risk associated with some of the trends that we're going to talk about today.
Great. Thanks, everyone. Just before the session, we were talking a little bit about the prior session on regulation and the increased enforcement activity, which was confirmed. And Brian, we were talking a little bit about this enforcement and your increased diligence with managers. Can you tell us a little bit about that?
Yeah, we're really looking at a couple of things. There's certainly a lot of focus on the new regulation and what that means to the operations of businesses. The other obvious trend is the increase in enforcement resources and an increase in the depth, if not necessarily the frequency so far, of examinations. So one of the things that we look for when we go to visit asset managers is whether they're really prepared for that. It wasn't too long ago, actually it wasn't too long ago in the U.S., you didn't even have to have a compliance officer as an asset manager. That changed in 2003, I think. And for the first few years, it wasn't uncommon to find compliance teams of one or two, and often a chief compliance officer who was a portfolio manager or maybe even a receptionist at some of these firms. That's changed because so much of the results of an exam now depend on first impressions. So we look for those same first impressions. We're looking to see if the teams are well resourced, if they have experienced folks that know what they're doing, and if they present well, if they look like they're serious about it and they understand what the risks are and they have a reasonable program to manage them.
Okay. And maybe Michelle or Tim, can you give some insight as to how you as a manager look like you're ready for such an audit, such an enforcement activity? What preparations have you made? What steps have you taken?
It's been a while since we've had a formal SEC audit, but one of the things that we do at the behest of a major client is every 2 years we do a mock SEC audit with a third-party provider. Yeah, it's work and it's expensive, but at least that means that every couple of years we feel that we're ready if we do get the real thing.
That's great. Tim?
Certainly, Caxton has dramatically increased the internal resources that we spend on compliance. I'm not sure our compliance has actually gotten that much better. I think it was okay before, but there are a lot of things that that we do because they're expected, and some of them are genuinely useful, some are not genuinely useful. Not very few of them are harmful, so I think from the investor's point of view, they're definitely beneficial. One additional complication for a fund like ours is that since we're active in quite a few global markets, we face regulatory initiatives from many different venues, and so that has increasingly become a challenge. And I'm hoping that over time, and certainly we've seen some evidence of this in the last year or two, that global regulators will cooperate more and provide more standardization, because we'd be happy to provide a broad range of data on our global operations to many global regulators. You know, we're not going to say, well, we're not going to tell you guys at the FSA in the UK about the US at all. We're fine doing that because we think it's cost efficient and provides a better picture of our overall operations, which are globally unified.
Great, thanks. Just speaking of global, we're talking about the increased risk, and not just talking about volatility here, other sorts of operational risk and even custodial risk that exists, especially in emerging markets. Mike or Brian, perhaps you can comment and expand a little bit on that.
Go ahead.
Sure. So I think one of the many lessons learned in 2008 is pay attention to where your assets are custodied and who your counterparties are. And one of the frontiers that I think has come a long way in terms of transparency is understanding exactly who sub-custodians are. So if you have a custodial relationship with someone, to have access to all the various places around the world, emerging economies that you want exposure to, you may actually have to sub-custody out to somebody who, as an investor, you may not have heard of. So even though you know exactly who your prime broker is, your prime broker has to find someone who can custody those assets sort of on the ground wherever that investment may be. So I think it's our job on the due diligence team to see, although we're not going to be able to track down and have the kind of transparency that Tim or somebody is going to in terms of seeing the visibility on where the risks are, but we want to see that the actual hedge fund is tracking and understanding where they have custody. And there are some funds that do a really fantastic job of knowing where their exposures are, and other funds who may not have any idea.
Brian?
Yeah, certainly Madoff called attention to the importance of knowing where your money is, but it's really been a growing problem with the trend toward investing generally. We've seen our clients go from about 50% domestic equities to about 2/3 either fixed income, illiquids, and emerging markets and frontiers. And it's exactly as you described. It's like those old ads about, it's 10 o'clock, do you know where your kids are? Do you really know where your assets are? Because some of these emerging markets, it's literally people walking across the street with a briefcase full of cash. And there are, in the more extreme cases, banks that you have to go visit personally to see your money. So one of the things that we look for with all of our strategies is following all the way down through the subcustodial arrangements to figure out exactly where the money is, how it's transacted, and who's really in control.
It seems to me this is an area where there's some very large potential public goods aspects, where it doesn't really make sense for 6,000 hedge funds to do the level of due diligence that's really necessary to get a good handle on all the legal and operational risks involved here. And so somehow I think we as an industry, and this applies also to non-hedge fund asset managers a little less acutely because they tend to be larger on average, we need to find a way to have this research be done responsibly and in a way that you can trust, but not by every single asset manager by themselves.
Sort of underwriters' laboratories for custody. and operations. Speaking of global operations, we discussed a little bit about FX clearing, and that of course led to a little bit of talking about the clearinghouses that are part of the new regulations. Can we talk a little bit about the FX in particular and clearinghouses in general, and how they may affect the risk affect counterparty risk and other sorts of operational aspects of the business?
Yeah, I think that was one of the surprises for us, at least coming out of 2008, is not all clearing systems are created equally. You can look at the paper and see similar customer protection rules and similar sounding bankruptcy rules and things like that. But when one of the brokers, as Clayman did, becomes subject to those, the difference between the way that accounts are actually moved in the U.S., say, on the futures markets, and in other markets is very different, and you don't always see that until the systems are tested. So a big open question that I have is how as we set up these new clearing markets, which I think are a great idea, how are the rules actually going to work? How are they going to interplay with the bankruptcy rules? Are people going to have access to their assets when their broker fails, to be able to move those positions over and keep their exposures on, or are they going to have to wade through an expensive and sort of opaque bankruptcy system, as we've seen with in some of the other markets?
I think net clearinghouses are a great idea. The biggest unknown that we're the most worried about is what the new margin requirements will really be, and what that means to individual hedge funds in terms of the capital intensity of their particular strategy. So whereas now you might have a hedge fund that has tons of free cash, that dynamic may change for the worse, depending on how this turns out.
Michelle or Tim, are either your firms thinking about these possible capital requirements at this point, or is it too early?
I think from our point of view, we're pretty happy with these developments. We certainly prefer the transparency of exchange-traded markets where you can see transactions and prices. There's something to be said for maybe non-minute-to-minute transparency in some cases, so I think there's room for discussion about how quickly trades are reported, but certainly within the day you use a real benefit, and the current system for trading a lot of OTC products has a lot of disadvantages. We also saw, of course, in the fall of 2008 that exchange-traded products weathered the storm in terms of trading quite a bit better. A lot of dealers, because they were under pressure themselves, couldn't afford to be in the market transacting, and they just pulled back. Whereas exchanges, because they don't have that same risk of, and weren't hit the same way, continue to function quite effectively.
And another thing to consider is, I'm all in favor of the clearinghouses and the exchange, but many of those are publicly traded entities. So we'll have to look carefully at their governance and their practices, and we need to make sure that none of them become too big to fail.
That's a very good point.